we start our analysis of Maru Batting Center customer lifetime value case, you should by now have read the case and be ready to solve it in Microsoft Excel. First, a few pointers. Regarding the demarcations of our approach, there are 4 market segments that have been identified for the clients of Maru Batting Center. And the marketing decisions have to be taken in the customer lifetime value analysis framework. We are, however, looking at point estimates of different factors. So, for instance, the response rate. If we throw that gala event for the elite baseball players to join our club, we have given a single point estimate, like 25% of them will be joining our club. So that's actually something that makes our model simpler, because if we had used the distribution functions, like there is some probability of 25% joining, there's some probability of 30 joining, for 20 joining, and so forth, then this more intricate model would have left us to use, for instance, Monte Carlo analysis and get like a more precise value for customer lifetime value of the customer. Now we didn't do that, and now we have to consider some things as a result of that. For example, similarly to our case, if you measure your height and you get the result that your height is 188.2325 centimeters, then the precision of such a measurement is hardly ever more than 0.1 centimeters, which gives us actually the height of 188.2 centimeters. Now, if we want to get a more precise answer, it's not given because it's indiscernible, because there are measurement errors. So we can't really get such an exact number as 0.2325 without making some measurement errors. And we have to also say that it's luckily also irrelevant, because we don't need to know the height with such precision. The height of 188.2 centimeters is enough for almost every purpose. So 2 things: due to measurement errors, it's indiscernible. Due to the fact that we don't need it with such precision, it's also irrelevant. The same is true here, because we have used only point estimates for things like, let's say, response rate. The customer lifetime value that we'll be finding at 5,556 yen only will be giving us a ballpark figure. Let's say that it's around 5,600 yen. But we can, however, compare that to another customer lifetime value we'll be getting of 5,916 yen, because this precision will be sufficient. We have some kind of a measurement error therein, because we don't know whether the values are really a little bit higher or a little bit lower. But the relevant information that we get out of it is that this 5,556 is sufficiently lower than 5,916 for us to be able to make a decision which option really is better. So we've lost some information, but not too much. Let us at once make a kind of a bit more advanced note here. So we're using customer lifetime value, which is essentially the net present value of dealings with the customer as a project. So we consider a customer as if it was a project, we calculate its net present value, and we see what comes out. Now, think of it this way, that if we compared in finance projects of different size, then we didn't really use net present value, but we used internal rate of return instead, because internal rate of return was a kind of a bang per buck indicator that gave us like how much do we get for $1 invested, how many percentages of return do we get, and it gave us comparable results in the case of different projects. So remember that internal rate of return was the discount rate that we would have to apply in order for the projects, in our case customers, NPV, net present value, to be 0. So IRR is the result, which is the discount rate for which our customer would have a zero return. Now, we could do, so this is like an advanced project for everyone. We could do this framework, try this framework here as well. Who wants to apply it? It would be interesting what you come up with. And to sum it up, it's basically a capital allocation problem. We have some kind of a constrained resources in our company, and we want to smartly use those scarce resources and get as much return as possible. Everything that we do in a company must also contribute to its value. So here's one link to the research piece that ties customer lifetime value analysis with firm valuation. So it's customer-based corporate valuation, integrating the concepts of customer equity and shareholder value by Bauer and Hammerschmidt, 2005. So this work really shows how those taking on more profitable customers contributes to the increase of the value of the company. Let us now move to the Microsoft Excel file, and first we have to fill in this left pane of the Excel sheet. We have the contact costs for little leaguers, summer sluggers, the two kinds of scenarios we see unfolding for elite ball players, the party or the printout scenario, and the entertainment seekers. So the contact costs, which were outlined in the case, are just simply written here. We see this cost as a kind of a historical average, for instance, for little leaguers where they sponsored the events, or we have it as it's planned for the, let's say, party that's to be thrown for elite ball players. Now, another thing which is just basically historically averaged or then planned is the response rate. So we already see different response rates. We already see actually how the like the subjectivity goes in here, and then we can really see that the exact number that comes out as a customer lifetime value is still somewhat a ballpark figure. Now, as for acquisition cost, it's just basically this 1,000 yens per person as a contact cost divided by 10%. So you see the acquisition cost for one customer for a little leaguers is 10,000 yen, and now we're going to copy it, and we see it's actually by far the most expensive for elite ball players. And the way we've estimated it, with 25% response rate and the party costing us 12,500 per person, we get their contact and acquisition cost to be 12,500 and 50,000, and even more, 60,000 through print ads, because the response rate is just so low. Okay, so now the next thing is, the next line has the workers needed lined up. So remember that the little leaguers needed to do maintenance for 2 maintenance workers, and so did the entertainment seekers. The rest of them needed 1. Now, worker labor costs are here, and the instructors needed are either a 1 or a 0. For little leaguers and elite ball players, it's a 1. And we're actually going to take the instructors' hourly labor cost, and we're going to put the zeros into those no answers. Otherwise, the formulas won't run right away. Remember that the elite ball players had a more expensive instructor, and the little leaguers had a less expensive instructor. And now the total labor cost that we'll have is basically just the workers needed times worker labor cost plus instructors needed times instructor labor cost. So it's just basically B7, B8, B9, B10 multiplied and summed like this. And now we are going to copy this, and we see that it's the same cost for elite ball players and little leaguers. it's less expensive for entertainment seekers and sluggers. Now, the workers needed are actually contained in our price package. So remember that that we had like a price package which was different for different buyers. We had already set in stone, so to say, the number of people who are going to be attending in those different pricing categories or clientele segments. And the salaries don't seem to be changing in the near term here, so this is also an observation to make. Now, the hourly price charged, well, this was given, so it was said to be given by the elasticity of demand. So remember, if you have a demand curve and your demand is more elastic, which means that it responds to price changes more, then you just can't put that high of a price. So that was the main rationale. Of course, here I would still say that this company has like kind of due to the lack of data probably taking those prices for like out of thin air. So they could have used some quantitative techniques there on for prices elasticity determination, like in revenue management, for instance. And the next thing is the hourly margin, which is basically just your hourly price minus hourly cost. So we see that for little leaguers it's 500 over the costs that our margin is, and this is the margin in turn, and then the margins are different. And we're also looking at what's the hourly margin percentage. So we're interested in how much this 500 is making of this total price 6,500. So the percentages here like less than 10%, but right now it kind of formats the data wrongly. So let's do such a thing that after we've copied the formula, we're going to be right click and format cells, clicking on right click format cells. Then we're going to have to select number and say that it's a percentage instead, because it's a hourly margin percentage. Now we can see that actually for entertainment seekers the percentage is quite high, which means that their hourly cost is 3,000, their price is 4,000, so we get like 1,000 above costs. But we'll see the problem with them is another, because they only spend 1.5 hours per year on average in the batting cage. Now the annual margin is essentially the hourly margin times the annual hours. So let's copy this as well, and we'll get those annual margins. And we have also here a retention rate. Again, remember, of course, that retention and attrition are like two complementary events. So if your retention rate is 75% for little leaguers, it means that you retain 75% of customers, and the attrition then is 25%. So that was actually in game there in the case, because sometimes they spoke of attrition, sometimes they spoke of retention. The sum of the two is actually always 1. And the interest rate we'll be using will be just basically our discount rate. So how high is the capital cost for us to be used in this situation? And it seems that the facility cost, we had to build a facility at some point, as well. We're not considering any new investments, so the facility costs are all sunk, which means that we just look at this amortization of the facilities on top of everything else. But we just want to see like what's the money coming in from new customers, not taking into account the facility costs. And retention rates again are some kind of a historical estimates, or to a certain degree also some kind of such a very judgmental call what the retention rates are. We're going to talk more about how the retention model works here in a second, but this all introduces such a subjective side of our model.